Kind words, thank you, Eric. Although at $5,000 gold, I don't think you should judge any producer on their ability to operate. I'll note that when we're making cautionary statements, and you can find this presentation on our website. Heliostar wanted to be a mid-tier gold producer, and we founded the company 5 years ago to achieve that. We've had a long stated goal of getting to 500,000 ounces by the end of this decade. And incredibly, because we wanted to do this before there was a really popular desire to produce in the market, we've been able to pick up a very deep portfolio of mines and development projects. That means organically we can grow to 300,000 ounces of that production by the end of this decade, and I'll run you through the progress that we've made. In the last 12 months, the big change that's happened for our company is we've been able to sort of solidify all these variably poorly defined opportunities into a sort of steady state production growth profile. And I'll run you through how we expect to achieve that over the next couple of years. But, as Eric presented at the start, the US fundamentally can't afford that debt burden, and that's changing the approach and the margins that gold companies are getting. You see it here on this chart looking at our La Colorada mine, in that margin expansion is incredible. And I think it is going to last for an extended period of time. And I think the companies that benefit from the most from this are small growing producers that don't need to go back to market for capital, that are getting paid so much more for the gold that they're producing and able to deploy that to grow a company that outside of this cycle is a low cost producer. And that's what we think we can deliver over the cycle. I touched on that ambition before, so I'll keep moving ahead. We've got 2 operating mines in Sonora and in Durango, and 2 development projects to build behind that. Primarily we'll focus and talk about Ana Paula today. We're spread from the north to the south. We've got over 6 million ounces of gold reserves, over 100 million ounces of silver. It's a deep portfolio that we finally put all the technical studies out that we can lay out on one page. It's quite incredible the depth and the ability to grow we have without any M&A risk. This lays out our value proposition really clearly. If you look at 150 to 250,000 ounce a year producers, you're looking at a minimum 2 billion market cap, on average 3 to 4 billion market cap. We started last year doing 33,000 ounces of production. Our guidance this year is a 60% jump on that production at the same costs. And we think the big step change comes in 2028 when we bring Ana Paula online. Follow that in 2030 with our Cerro de Gallo project coming online. What we can see here is kind of that virtuous arc of increased production and, most importantly, decreased cost. As we bring on new mines, there's kind of 2 ways I think you can grow in the gold space. And everyone wants to grow quickly, and that means buying assets. And typically that means increased all-in sustaining costs because you're buying mines later in their mine life. The only way to truly lower that cost is to build mines, but that takes time. So you've got to try to balance that growth with acquisition with your organic pipeline. I think we're in a really strong position to do that. We think we can exit 2028 with just under a 200,000 ounce a year run rate. We're just under 800 million market cap, 300 million shares fully diluted. We've got 40 million in cash in the bank. We expect to produce, as I said, 50 to 55,000 ounces of gold at just over a $2,000 all-in sustaining cost. We're going to fund $27 million worth of exploration across our portfolio this year. We're going to put the decline down at Ana Paula. We're going to fund the pre-strip of another pit in our La Colorada mine. And if gold stays at 3,800 range, we're still going to have 40 to 50 million in cash in the bank. If gold stays anywhere near these levels, our ability to generate cash is very significant. I'll keep moving through the presentation for time. The key 2 production assets, as I touched on, are about equally weighted at La Colorada and San Agustin. They were turnaround stories. They were mines that were either in care and maintenance or going into care and maintenance. We've received permits to restart the San Agustin mine last year. We restarted La Colorada in January. We restarted San Agustin in December, and we're going to do an open pit expansion at La Colorada this year. It's been a very significant change in our project portfolio. And so if we start with La Colorada, we own 100% of it. It's royalty-free. We took it from care and maintenance to a 6-year mine life over the last 12 months. The big opportunities that we see is if we look at what was our upside case, is strangely a conservative case in this gold price environment, just under 250 million NPV on that project, averaging just under 50,000 ounces of gold for the next 6 years. If we look at that closely, we've actually been making our money. This stockpile is gone. This stockpile will be gone this year as well. We've been able to make money out of what was waste at old gold price environments. Now we're going to move to cut back this pit here and produce from here next year, and then go and do the larger Creston expansion. It's been a very effective, low capex pathway of stockpiles to smaller pit pushback to large pushback. And now we can focus on growth. We think there's going to be a larger pit at Veta Madre, and we think it's open at depth with some really great deep results underneath. There's almost been no exploration at La Colorada outside of the mine trend, and this year it'll see that for the first time in 15 years. If we jump ahead to our San Agustin mine, that's the best slide here. This is carrying the most of the pit. You see the blast hole data here. There was an area here that we needed a permit to restart, and we got that in July last year. We're currently producing. We'll produce about 45,000 ounces of gold over the next 14 months at San Agustin. If we look at the economics of that, I think we go back here, we were going to make about 35 million in NPV at $3,000 gold. At these gold prices, we're going to make $80 to $90 million over the next year and a half at San Agustin. Collectively, we think we can generate at conservative gold, that 350, 380 gold price, we can make close to $150 million out of our 2 operating mines in the next 2 years. And we're going to spend that building our Ana Paula project. And so Ana Paula is that real step change in quality for us. We put a PEA out in December showing a 9-year mine life at 100,000 ounces a year. We think in the FS we're completing at the moment, we can get that to 10 years at 100,000 ounces. We're going to mine a 60-metre wide ore body, averaging about 5 grams per tonne gold, and that's going to give us a 1,011 all-in sustaining cost. If we were to turn that on today, that'd be just nearly $4,000 margin. Ana Paula is going to generate, in our opinion, very, very significant free cash flow. You can see at $3,800 gold, there's $1 billion return on a $300 million capex. And the kicker for us, we think we can project finance that gap. 150 of our cash flow, 150 that will project finance, debt finance. So we don't think we're going to need to issue any equity to build Ana Paula. I'm not saying we'll never issue equity. If we can grow the company, we reserve the right to. But we think where we stand today, we can bring Ana Paula online, build one of the lowest cost, highest margin gold mines in the space. If we do that, if we get to that 2-3 billion market cap that our peers are doing production without growing our shares, that's a 3 to 4x on where we are today, without taking discovery risk, without taking a dilution risk. We also think we can further grow it. We've been able to put out some spectacular drill results over the last couple of months, consistently 50 to 100 metre drill results at anywhere from 5 to 20 grams per tonne gold. Ana Paula is open. It's got significant depth potential. Some of these deeper holes, 13 metres at 30 grams, 40 metres at 6 grams per tonne gold. Geologically, we're shallower than our neighbours. If we go deeper here at Ana Paula, the geology says you'll hit a contact intrusion, and if we look at what Torex have at Morelos and Los Filos have, they're 15 and 20 million ounce deposits, all sitting geologically lower than we are. So we're going to push the decline down this year, and that's going to be a great step forward and de-risking step for our production, but it's also going to give us a platform to see how big Ana Paula truly could be. And so if you look at our news flow this year, it's sort of based on 3 levels. What we like to back up is the execution, the confidence in us as a company to do the things we've said we would, and I'm quite proud of our performance over the last few years. On the top of that, we think then that by funding the decline at Ana Paula, by doing the pre-strip at La Colorada, we're making big investments in our company that are going to pay off the following year. And then we've got 8 rigs turning. We're going to have results this quarter from Ana Paula, from La Colorada, and from San Augustine, and we expect to continue drilling and putting out those results throughout the year. The combination of production growth and upside, I think, presents a unique opportunity for people who want to invest in an emerging mid-tier gold producer. Thank you.